When you invest in real estate, you choose a path. You can be an active investor, deeply involved in operations, or you can be a passive investor, more hands-off. The Internal Revenue Service, the IRS, views these roles very differently. This distinction is not just a label, it is absolutely fundamental for your tax strategy. It significantly impacts how your investment income and any potential losses are treated by the government. Understanding this from the outset is crucial for building wealth through property. Active real estate investing means you are boots on the ground. You materially participate in the property's management and operations. This involves making significant decisions regularly and dedicating substantial time. Think about personally overseeing a house flip, from acquisition to renovation to sale. Or imagine managing your rental units directly, handling tenant screening, urgent maintenance calls, and all lease agreements yourself. You're essentially running a hands-on real estate business with direct involvement. Passive real estate investing offers a different approach. Here, your primary contribution is capital, not your day-to-day labor or operational expertise. You are not involved in the intricate operational details of the property. Common examples include investing your money into a real estate investment trust, or REIT, where seasoned professionals manage a large, diverse portfolio of properties. Another example is being a limited partner in a real estate syndicate, or owning a rental property that is entirely managed by a dedicated third-party property management company. It is crucial to understand that the IRS defines material participation with specific tests. It is not merely about how much time you feel you spend, but whether you meet their detailed criteria. These criteria can include the number of hours you spend annually and the precise nature of your involvement in the decision-making processes. Grasping whether your activity qualifies as active or passive is the critical first step. This knowledge empowers you to plan effectively for the tax consequences of your real estate investments and optimize your financial outcomes. Many investors are surprised to learn that a rental property can show a loss on paper for tax purposes. This can happen even when tenants are consistently paying their rent on time and the property seems to be generating positive cash flow. The reason for this apparent contradiction is that total deductible expenses can exceed the rental income reported. These expenses include mortgage interest payments, property taxes, and insurance premiums. Beyond these, there are costs for repairs and ongoing maintenance. Furthermore, a significant non-cash expense called depreciation plays a huge role in the tax calculation. The IRS allows you to deduct a portion of your property's structural value each year. This depreciation expense can be substantial. It often turns a positive cash flow situation into a taxable loss, which is a key tax benefit real estate investors seek. So, what exactly is a passive loss? A passive loss arises from a passive activity. For most individuals, rental real estate is automatically classified as a passive activity, unless they qualify as a real estate professional. For instance, if your rental property brings in $20,000 in gross rent, but your total deductible expenses add up to $24,000, you have incurred a $4,000 passive loss. These passive losses are treated with special attention by the tax authorities. You generally cannot take this loss and subtract it from your regular job income or investment portfolio income. The IRS has specific rules known as the Passive Activity Loss or PAL rules. These rules prevent taxpayers from using paper losses to shelter other income from taxation. To control the use of these potentially significant losses, the IRS implemented the Passive Activity Loss or PAL rules. These complex regulations fundamentally limit how and when you can deduct losses generated from passive investments, including most rental real estate. The core principle behind these rules is straightforward enough in theory. Passive losses are generally only deductible against passive income. If you do not have enough passive income in the same tax year to absorb the passive losses, those losses are restricted and cannot be used immediately. Let's consider a clear example to illustrate this point. Suppose you have a $15,000 passive loss from your rental property this year. This loss has been calculated after all income and expenses including depreciation. However, you have no other passive income from other rental properties or other passive business activities during this same year. In this common scenario, that entire $15,000 loss is typically suspended. This means you cannot use it in the current tax year to reduce the taxes you owe on your wages or your portfolio income. Instead, this loss is carried forward to future tax years. However, there is a notable exception that many smaller real estate investors might be able to utilize. It is often referred to as the $25,000 special allowance for rental real estate activities, Under this specific provision, if you actively participate in your rental property, you may be permitted to deduct up to $25,000 of your rental losses against your non-passive income, such as your salary. Active participation is a less stringent standard than material participation. It usually involves making key management decisions like approving tenants, setting rental terms, or authorizing capital expenditures. It is vital to know that this $25,000 special allowance is unfortunately not available to everyone. There is a significant catch-in income limitation based on your modified adjusted gross income, or MAGI. The ability to claim this deduction begins to phase out once your MAGI exceeds $100,000 for the tax year. If your MAGI is above $150,000, this special allowance is completely eliminated. This income cap means many investors, particularly those with higher earnings from their jobs or other businesses, cannot benefit from this particular provision for deducting rental losses. Given these intricate rules, it's important to know which strategies can help you maximize your real estate tax benefits. One powerful approach is the so-called short-term rental loophole, which can allow certain investors to avoid passive loss limitations. If you rent out a property on a short-term basis, like a vacation home or Airbnb, and materially participate in its management, your rental activity may be treated as non-passive for tax purposes. This means you could potentially use rental losses to offset your other income, even if you don't qualify as a real estate professional. Real estate professionals, as specifically defined by the IRS, also have this advantage. If you qualify for this coveted status by meeting certain rigorous tests related to the amount of time you spend in real property trades or businesses and your level of participation, your rental activities may not be automatically treated as passive, opening the door to greater tax deductions. Another advanced strategy is cost segregation, which involves breaking down a property into its individual components for tax purposes. By accelerating depreciation on items like appliances, flooring, or landscaping, you can increase your deductions in the early years of ownership. For example, a cost segregation study on a newly purchased rental property might allow you to deduct tens of thousands of dollars sooner, improving your cash flow. These strategies, along with the $25,000 special allowance for active participants, can make a significant difference. However, always remember that income limits and IRS definitions still apply. Your modified adjusted gross income, or MAGI, and your participation level are key factors in determining your eligibility. For those with MAGI below $100,000, the special allowance can be especially valuable. But as your income rises, these benefits phase out, and losses may be suspended until you have future passive income or sell the property. That's why understanding and applying strategies like the short-term rental loophole and cost segregation can be so impactful. Provided you meet the requirements, these approaches can help you offset more income and accelerate your path to financial goals. For high earners who do not qualify as real estate professionals, passive rental losses are typically suspended. They must wait to use them until they generate future passive income or dispose of the property in a taxable sale. Why is a deep understanding of these tax rules so critically important for every real estate investor? The answer is simple. It directly impacts your financial bottom line and your overall net return on investment. Knowing how passive losses, short-term rental strategies, and cost segregation are treated by the IRS allows you to make more informed and strategic decisions. It can influence your choice of investment properties, how you manage them, and your long-term tax planning. This knowledge transforms you from a hopeful investor into a strategic one. To summarize, first, determine if your real estate activities are active, passive, or qualify for the short-term rental exception. Second, be aware of passive loss limitations and how strategies like cost segregation can accelerate your deductions. Third, always consider your income level and whether you qualify as a real estate professional or for the special allowance. And finally, always consult with an expert in these strategies. For a free consultation and more information, contact David Weiner at 770-224-8504 to help understand how these strategies apply to your individual investment plan.